everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and I'm joined today with a very special guest to talk about the Trump economy, kind of what's going on, macroeconomics, thoughts on crypto, thoughts on precious metals. And in this world, as we end this dynamic year here in 2018, we're down roughly, 8% in overall U.S. stock markets from October. I mean, only a couple months here, things have kind of turned around in a hurry. But it has been a volatile year here in the markets. I mean, almost nothing has been safe. And in fact, it can be said that the US dollar has been the best performing asset of the year. So to discuss this with me is a financial expert, someone who pours his heart into the markets, into macroeconomics. It's Andrew Zaitlin of MoneyballeEconomics.com. Andrew, thanks for coming on Crush the Street with me today.
Thanks for having me. It's interesting. I actually been doing pretty well this year in my personal account. And I don't know if we're allowed to talk specifics, but, I have this thing I call the Vice Index, which tracks consumer discretionary spending on gambling and things like that. But I personally invested in what I want to call the Family Index, which is a triplet of stocks, which are basically, I noticed I'm spending a lot of money on a handful of companies. So I went ahead and put my money into them, and they've been outperforming like crazy. So it's been an interesting year for me as I've been sitting back going, what collapse? I don't see a collapse.
Well, I think for the mainstream, looking at the overall economy, it's been a roller coaster ride. For people who voted for Trump, it was a lot of enthusiasm and a lot of excitement from the time he was elected into the end of 2016 into 2017, a lot of enthusiasm, a lot of excitement, stock market,
right,
kind of reinforcing that upwards momentum, money being repatriated. But then as we approached the midterm elections, it seemed like things got on shakier grounds here. So I'd like to get your thoughts on where we are right now as a macro.
Let's do that. And let me be clear, I got lucky this year. It wasn't like I'm a brilliant man. As we know, there's no such thing as a rich economist. I just got lucky this year. So let me give you what I think are the major waves that have been, ebbing and flowing, and what to expect. And just to cut to chase the punchline, I'm actually fairly bullish as we step into next year. And let me explain why I say that. On the one hand, last year about this time, we got that sugar high of the tax cut. And obviously that wasn't just a consumer thing. It was a business thing. They got a lot of profit margin boost. That then promptly led, as we entered 2018, to this huge rush. Profits were surging. The market reflected that. But things got a little bit too one-sided. And I want to throw out there the following premise that, the market started to price in two things. One was interest rates have been going up, and the consequent impact of rising interest rates, we've started to see the housing sector slowing down. Things start to slow down a little bit. And the market was slow to price that in. So that's one thing. No matter what, when you start raising rates, you're going to start to see a little bit of a hit in the stock market. But I think the other thing that started to get priced in was also what's coming down the pipeline, not just as the sugar rush starts to slow down, but also as we start to get that self-inflicted wound from the China-U.S. tariff. Now remember, that doesn't have an immediate effect because Trump's team broke it into pieces where the first piece was attacking China's exports that really we can go somewhere else for. Most of these things that Trump initially hit have a lot of substitute goods, so it wasn't going to drive any inflation. It's the next wave. It's what comes down the pipeline. We're going to have that year-over-year effect. The sugar rush is over. Now we've got the next wave of tariffs that do hit the U.S. Businesses in a negative way. So I think that started to get priced in. But the third and last thing, I think, the reason it just suddenly felt like it happened overnight, which it kind of did, right? From September to now, it's just the markets have fallen off a cliff. I think that has to do with a technical thing. And if you take a look at short positions, what happened was you had a lot of players in the market, a lot of whales basically saying, you know what, this is unsustainable. It's time, everyone is so long, it's time to go really super deep short. So what you actually had was a very technical thing playing out in October, November, where you had a downward spiral. As short selling started just dominating the market, prices started falling, then you had the consequent fire sales. Everyone's so over leveraged in the stock market right now that the margin calls started coming in. So then you had everyone selling and selling and selling until finally a bottom was established. I think part of that bottom being established is you started to get some softer macro data in. So let's talk about that for a second. But bottom line, what happened is the Fed in the past couple of weeks has sort of started to say, well, maybe we don't want to raise another rate for a while. Let's wait and see. And so the market, again, likes that messaging. But in fact, it was just oversold. So why do I say it's oversold? Well, again, that fear is the U.S. economy slowing down. You actually had people starting to raise their hand and mention the R word, recession, coming down. So a couple data points to talk about. I sent out a piece earlier this week where I looked at jobless claims. And by the way, I was one of the most accurate today for jobless claims, which again collapsed. And that's because what we had was you have some non-economic news suddenly making the signal that, oh my gosh, the sky is falling. Jobless claims were one. They went from about 200K suddenly overnight going up to 230K, 230,000 jobless claims. Oh my God, we have this multi-week rash of layoffs going on. But people forgot that was because we had storms and hurricanes. The hurricanes have come and gone, and now all of a sudden jobless claims have fallen again. We also had payrolls come in last week, and those were softer than expected. And a lot of that again was just the storms. So what we have is the timing of some negative signals makes the Fed blink a little bit. But bottom line, the underlying economy is still very strong. Maybe we've seen the best of the most recent good news. You know, I'm not calling a top by any stretch of the imagination. I'll tell you why. The first thing Nancy Pelosi said after the midterms, the first thing was, we look forward to working with Donald Trump. Don't quote me on this. It's not verbatim, but we look forward to working with Donald Trump on the infrastructure bill. Now, why is that? Well, the reality is Trump has boxed the Democrats into a corner. As his first economic pass of throwing out a tax cut starts to wind down, the benefits of that start to wind down next year, we're now going to be less than 2 years away from the next election of 2020. So the campaign issues start to come front and center. If the economy starts to slow down, Trump has a couple of things in his back pocket. The biggest one is this tariff war. A lot of the question marks right now in the global economy come back to China, come back to the fact that China really depends on exporting, and the U.S. has effectively erected a wall, and they're struggling. China auto sales collapsed for the first time in 30 years. I mean, you can just trot out any data point related to China, and they're struggling. They're losing tens of billions of dollars a month simply because the U.S. said, time out. So they're desperate to make a deal. Once that deal happens, again, the global economy will surge. U.S. exports will take off because, let's face it, the number one beneficiary of a deal will be U.S. companies. So next year, we've got the China tariff thing kicking in. That's the I'm fairly bullish. But even if that doesn't happen, even if there's something else going on, you still have this infrastructure bill that can be talked about. So here's where the Democrats are in a problematic place. If the economy slows down and Trump throws something out like, let's legalize marijuana, or let's do an infrastructure bill, the Democrats have to go along. If they don't, then they look like the party of no. If they go along, then Trump gets the benefits. So for Trump, he's in a win-win position no matter what happens with the economy, because he can just throw something out. And if the Democrats start to slow him down during the election campaign, he'll say, hey, it's not my fault. It's those guys over there. They're throwing up roadblocks. That's politics, but politics does matter as we go into an election situation. Next year, though, I see nothing but blue sky. There's one more data point, Kenneth, if I could share it. It's one of these minor things. Now, I mentioned that hurricanes hit jobless claims, and therefore everyone got skittish. You know, it just seemed to add to a little bit more of that concern. There's something weird going on in the semiconductor world, and I'm a big proponent of semiconductors as a great window into what's going on with the global economy. Semiconductors are in everything. So if you want to know how the world's doing, look at the consumption of semiconductors. Intel screwed up. Now, follow the logic here. Intel screwed up. They didn't think PC sales would be as strong as they were, so they didn't make enough of the Intel inside chips. Why does that matter? All of a sudden, you've got a bottleneck. All of a sudden, companies like Micron Technology, they're making DRAM chips, but they can't sell them because there's this shortfall. Basically, PCs suddenly aren't being made at the volume that's demanded. So this massive supply of semiconductor chips is piling up. So they do what they have to do. They sell them off at a deep discount. So into the fourth quarter, what we've had is this big semiconductor price collapse. And again, if people look at semiconductors as that proxy for macroeconomics, they saw nothing but bad news. Oh my God, the sky is falling, demand is falling, shipments are down, prices are down. But again, it all comes back to one thing. Intel screwed up their production. And that's a positive thing. Demand was higher than they expected. They just couldn't meet it. And everybody else in the supply chain was ready for it. That gets worked out over the next couple of months. As we get into the first quarter, you will see semiconductors firm up. So again, what we're going to see is this sudden reversal of bad news. We're going to see a lot of good news suddenly rushing in. I predict China and US will have some kind of agreement in the first quarter. You'll see other macro data points come in, and everyone's going to say, oh, yeah, that market collapsed. That's history.
So, Andrew, it's kind of interesting. It really does seem like the stock markets are these propaganda averages. To say that when we see stocks up, it very much connects, what's going on in the economy to the average person, which doesn't make a whole lot of sense, by the way, because the average person in many ways doesn't own stocks. It's the ultra very rich 1%. And when stocks go up, that's how the income inequality even starts to worsen and get exacerbated. And we can start talking about low interest rates and loose monetary policies.
Yep.
But what I really want to ask is this upward bias that seems to be in the stock market. I mean, you go back into 1987 when we had that 22% correction. I mean, the beginning of the year, the S&P 500 was 265 points. By 1990, the S&P was 339. It was like, a double. Yep. In just a couple years, despite that horrible crash that we had. So maybe as a follow-up to what you're saying, can you talk about this, maybe upward bias, if you even buy that?
Yeah, no, I do. So there's a structure.
But, what are your thoughts on that?
Something very structural changed as we came into 1990. And like you said, a lot of this is happening in the background with big money. But bear in mind, one thing happened in the early 1990s. All of a sudden, the 401ks emerged. 401ks were legalized in the late 1980s. Until then, you had pensions. That's it. 401ks did something differently. All of a sudden, everybody was participating in taking a portion of their salary and putting it aside and essentially putting it into the stock market. In essence, you had a huge new source of demand for stocks. The average person isn't buying, like you said, stock. They're buying a mutual fund, which is basically a basket of stocks. So first of all, I would say structurally, you just had suddenly trillions of dollars of new demand. In fact, this year, you've got, 140 million people working. Break that down. How many of them are putting money into their 401k? And then you've got company matching. Everyone just basically gang rushed the concept in the 1990s of 401ks. Let's put money into buying stock. So you had a huge
let me
source.
jump in right there.
Yeah.
Does that mean that there was an opportunity for a new rush of buyers into the stock market? And is it possible we've reached some level of saturation with this new buyer base of 401ks that are already?
Absolutely. Because remember, at the same time, that's when all of a sudden the stock market discovered leverage in a whole new way. Barbarians at the gate. It's I think fundamentally what you're seeing now is at the margins. Hey, if you get another 2 million people coming in and a bunch of them put more money in. But the key here is this: no matter what, most of American workers are shoving money into the stock market through their 401ks, and they're doing it blindly. Just every paycheck, a little bit gets taken out, and so that money has to go somewhere. So no matter what, you have a safety net for the stock market at some level. Then you throw things on there where the money managers are playing games with that money, borrowing, leveraging, and all that good stuff. But I would say that's the first and the biggest reason why you've had this upward bias. No matter what, trillions of dollars are going in. Yeah, you get into a recession, a few people get laid off, you have a little bit less money chasing stocks. But the other thing, I would say structurally, is you had the internet come in. Now, the internet, people really need to understand what the internet really was in the beginning and ultimately what it really is. This was a warehousing tool. This was a tool for companies to know what products they had in the warehouse in real time and communicate accordingly. That was originally where Oracle came in. Hey, we will help you know what you have in your warehouse. Going forward, again, it created the following opportunity. All of a sudden, companies reduced the amount of capital that they locked in with inventory. All of a sudden, they knew a lot of that excess inventory wasn't needed. So that was the first step. All of a sudden, companies had better cash flow, better margins. but it just went from there. You then got the just-in-time delivery. So what you had is this wonderful convergence in the 90s of a real fundamental supply chain that tightened up, and that suddenly companies no longer had to lock in a lot of their money. If you wanted something, you could get it from anywhere in the world. And the internet did this too. It opened up communication. All of a sudden, China, you could get stuff made in China, shipped here within a week. Prices collapsed and inventory costs collapsed. It freed up money. It also created new customers. Let's face it, you could sell more to India. You could sell more to China. Bottom line, the internet, the impact on the economy, this has been huge. It's been very productive. And so that creates, again, a lot more bump into the stock market. And it continues. We continue to get some great economic efficiencies. Having said that, I mean, let's face it, as interest rates have also moved, they've stayed pretty low for what? Almost 20 years, starting with Greenspan. We've had really low interest rates. Bottom line, you've had these wonderful waves, but they're played out. I mean, are interest rates going to go up? Yeah, maybe a little. I mean, I don't have a crystal ball here. They're not going to go up to 5%. They're going to stay pretty low. So you're going to have now this permanent problem of low interest rates, which are going to inflate assets because, you could buy a lot with a low interest rate. But things are I would say all these waves have more or less peaked. And so now everyone's casting about for the next big thing. What's going to drive the stock market up? Whether that means, is the economy going to improve? Yeah, sure. I mean, the U.S. is going to sell more to China. That's a huge win over the next couple of years. You get an infrastructure bill. That's a huge win. Moving something. I live in Silicon Valley. Driving around here is crazy nuts. The amount of lost time being in a car going to and from work is crazy. You fix that, you've opened up avenues of efficiency. But yeah, I think straighten up. You just have that underlying demand.
So Andrew, interesting. You brought up the internet, and it reminded me of another factor, another variable that maybe a lot of us don't factor into the growth of the U.S. economy or the global economy, and that's just human innovation, the human innovation factor going forward. So all things being equal, yeah, maybe we were overvalued at a certain point, but then you add this massive revolutionary sea change, which creates, this huge economic boom. Who knows what is going to happen over the next 10 years that's going to flood the stock market or the global economies to another level. It may not happen, or we might have something brand new. And how much should we be factoring in that human innovation and human resilience into the fundamentals of what we do when we invest in the economy?
So again, at the end of the day, if you look around the world, you have to feel very positive about the U.S. stock market for one basic reason. The U.S. economy, the U.S. has one compelling advantage over every other economy in the world, and that's respect for intellectual property and respect for individual rights. What that translates into is if you are a scientist or an engineer and you've got a great innovative idea, are you going to, for example, patent it and try to go to make your fortune in China, where it will be rapidly stolen intellectual property theft? Or will you come to the United States, get some money from a venture capital, start your company, get your product out the door, and go IPO on the stock market? Which is going to enrich you more? Well, the U.S. is. And so that's why we have all this talent trying to come here. And when you think about it, Alibaba, one of the world's largest companies, if not the largest company, the largest Chinese company, did their IPO in the United States. They did that. That's a feather in the cap for China to have the world's largest IPO. But they did it in the U.S. primarily because they knew that we have respect for property rights in a way that China doesn't. I mean, how many business leaders have disappeared in the last year in China? The head of Interpol was disappeared in China, So the respect for intellectual property and civil rights is so special and unique to the United States that we will continue to attract the innovation. And that is going to be a huge source of value to the stock market. Companies like Uber, for example, that started here. Yes, they're mimicked everywhere else, but the impact on the U.S. economy is huge. If you look at the impact on car buying, that's going to be huge. If you look at the impact on taxi cab drivers, the number of taxi cab drivers over the past few years, it's dropping. Well, obviously, the opportunity to put some side gig money into people's pockets translates into some positives for the economy. And again, over and over and over, I look at the U.S. economy as strong, It can always get stronger. It can get weaker. But by and large, from a sustainable standpoint, if you put money in the stock market in the US today and you're retiring in 20, 30 years, you'll be happy. Yeah, there'll be ebb and flow, but you'll be happy. You can't say the same for
Andrew, I'd
France.
like to get your thoughts on cryptocurrency here. I know you have more of a bearish outlook on it, which is absolutely fine. We've definitely covered it here at Crush the Street, and we tend to be a little more positive about the future of it. We've largely covered it in 2016 prior to that bull run. So we're very happy here with the gains and what we were able to do with it. So having said that, we're open to, a real discussion as to, the future, what to expect down the line. So, feel free to share your thoughts here at Crush the Street.
So let's start kind of sort of with the history of Bitcoin. And I'm going to be very generalizing and passing over some key facts, but bottom line, it does go back to the internet. The internet enabled a digital currency. There's an important reason why I'm more bearish than bullish on crypto, but I'm still somewhat positive. But I'm going to be positive for reasons maybe most people don't expect. The origin of Bitcoin, crypto, whatever you want to call it, was simple. The Federal Reserve messes with the dollar too much, right? They create inflation, they mess with the dollar. So we have this desire to create something that can't be messed with, that has, like gold, a finite volume, and that mining for it has a certain cost that will lead to a value. In essence, we've got a means of going full on digital with our currency. The dollar is pretty much digital anyway. You use your credit cards all the time. That's a digital expression of the currency. The problem with what was going on with Bitcoin was you had the hot money driving it. You had basically a lot of deep pocket whales trying to force certain things with it and creating a market. It's not a coincidence that once you could short Bitcoin in December of last year, it started to crash. Okay, smart money knew what to do. But let's talk about what Bitcoin is supposed to do versus what it is doing versus what it can be. Just because something starts in one place doesn't mean it's going to stay in that way. So again, the idea was this could be something used for transactions. If you're in a third world country, cryptocurrency is manna from heaven. Okay, if you're in a third world country, you do not have a banking system the way we have here. If you have gold and you have crypto, let's compare and contrast that. If I'm concerned, I'm in Iran, there's some things going on, I want to put some money aside and save it, I'm going to buy gold. Well, gold has a handling fee of, let's say, 2-3% up front, 2-3% on the back end, and it's fairly stable on a day-to-day basis. So let's say I'm going to lose 5% when I convert my cash into gold. Crypto, oh my God, that thing swings 5% in a day, but it has almost no transactional cost. So again, it's the same. So if I'm in a third world country or fifth world country, crypto is pretty interesting to me because by and large, the cost is the same as long as that 5% swing goes up and down. It doesn't trend down or trend up. But the key here is I can put it on a SIM card. I can hide it. I cannot hide a brick of gold. It can get taken. So if you're in a third world country, crypto is pretty appealing. If you're in the US, crypto has an uphill battle. But that's the storage of value. The second is transactional. And unfortunately, Bitcoin hasn't really made inroads transactionally. And there's two reasons. One is banks don't want it, right? Because they're threatened by cryptocurrencies. The ability to do your transactions on a global ledger without going through the banks scares the bank, scares the incumbent. So they've been definitely hitting the brakes. And there's a history here. The origin of the Fed is simple. The Fed was that trusted third party where you could cut a check on Bank A and Bank B would accept it. That was the role of the Fed originally. They were just that third party company. Well, fast forward, the Fed's mission has changed. Do you still need an intermediary? No, you don't. And that's what crypto is all about. You can bypass the intermediary. The problem is transactions. I can't go to Walmart and use any crypto. I can't. And I won't. I will never be able to do that because, again, if I want to use crypto at a Walmart, they have to now take on things. It's like the equivalent of using a euro. They've got to hedge it. They've got to accept it. Why would they accept that nonsense? They won't. It's an additional cost. And so the question is, what is crypto really all about? Crypto as a safe haven, like a gold replacement. Unfortunately, crypto has failed in that role in the last few weeks, as we've seen. In the turmoil, starting with Turkey over the summer, no one fled to crypto. You didn't see economies like in Iran or Venezuela suddenly going, I got to get more crypto because my currency is dying. They didn't. Gold, yeah, it was there. Crypto, not so much. I think that's part of why it started to collapse is you have people getting burned. And now let's talk technical here. If the role of crypto is to be a safe haven, I think it failed. If the role of crypto is to substitute as a new currency, it's not taking off. So we have a problem here. Is crypto basically like collecting baseball cards? If so, does everyone have their baseball cards? Let me talk two technical things, though, if I may. The first is most people who own crypto bought it when it was around 4,000 bucks, and it's now below 4,000. That's a problem. You have a lot of paper loss. The second issue, though, is really fundamental. In order for crypto to function, you have to have miners mining it. And the cost of mining is now close to the price of Bitcoin.
Which always changes and adjusts.
It will change, it will adjust, but it's now on a downward trend. So what happens is now you have problems. If you're not actively mining, then the concept of having this ledger falls apart. It only works as a ledger system if you've got transactions and if you've got mining going on. And the volume of transactions has plunged. I mean, we're not talking about price now. We're talking about the number of Bitcoin transactions. I'm going to use Bitcoin as the proxy here. It's plunged. I mean, it's fallen by half in just the last year, which means you're now starting to see a lot of problems with the fundamentals. A third technical issue. It is so easy to take out the entire system. There are only a few hundred servers out there, nodes rather, supporting crypto. Less than 1,000. You know how easy it would be to hack them. Now that's the negatives. Is I'm saying basically, look, technically we're starting to face the saturation point with crypto, and where it goes from here is, in my mind, we're heading back below 1,000 bucks. We're heading back to that 2011, 12 when it was 200 bucks. It was a way to dodge the dollar system, and I think there will always be that. I'll tell you, that's the only reason I'm positive about crypto. De-dollarization. In this world of ours, the dollar reigns supreme, and there are countries that don't like that. Now you can talk Russia doing, crypto trading, or Iran or Venezuela. Hey, that's marginal stuff. Nobody really is gonna do much there. And there's a lot of people out there who would put their tinfoil hats on and be paranoid and say, well, there have been revolutions and there have been assassinations based on de-dollarization. I don't know anything about that. What I do know, though, is China and Russia would love to knock the dollar off its perch. Just because. For China, it's important that their currency get a stronger foothold in the global economy. De-dollarization is a great way to do that. That's why I think you're always going to have a Bitcoin, because you'll always have a Russia and a China supporting it at some level because it's an anti-US play.
Points well taken. I don't know if I fully embrace everything on the degree of
you shouldn't embrace it
on the spectrum. Disagree. I mean, there's a whole spectrum of that. I mean, starting off with just saturation. I mean, it could be argued that we're far from saturation based on its use case over time.
To your point, yes, the level of usage at a country by country basis can only go from here. But again, it's compared to the amount of dollars. So if you're talking individual usage, look, is Bolivia saturated? Is everyone in Bolivia using the crypto the way they should or could be? No, absolutely not. But the economies that matter, Western Europe, the U.S., even Korea, Japan, you've already seen a slowdown in the volume, but more critically, just globally, because they're slowing down, that's what matters, because also that's where the servers are.
Yeah, well, and again, there's stuff to unpack of that too, right? That was because we're coming off of this hyperbolic bull market, and we need to wash through this. So to have to wash through this bear market, we're going to see a lot of downward pressure, and how low that can go. I mean, I'm very open to a very brutal bear market. That's something we've talked a lot about here. A lot of people, it's hard to imagine how bad things can get in the midst of a bull market when it seems like everybody is piling in, all the big money's coming into play. Let
me ask you a question, because it's a fascinating thing to watch. It's like the cannabis market, a whole economy suddenly going above ground. With crypto, and this sounds like a great conversation that we should have at some point more leisurely. I think that what happens is, why it shot up to $20,000 last year is a whole discussion. But when it hit $20,000, everybody piled in, and not the hot money. I mean, all miners piled in, and that drove the price down pretty rapidly, because again, that's what happens when you have that type of currency. And so Have we settled? Have we reached a new bottom? I don't know. I've heard Mt. Gox is still selling, billions of dollars that they have to sell. I think you're going to have something there. Cryptocurrency is useful. Blockchain's even more useful because it has more of a use case. Bitcoin is still struggling to find the use case. I feel bad for the Winklevoss twins. Should I feel bad for them? I'm not sure I should feel bad for them. But
they're above the level of luxury in life. They're in an excess of luxury where, if they lose a little bit of it, it's maybe not.
Yeah, I think they found ways to hedge their situation.
Yeah. Well, what was your question?
Do you think that? What are the use cases? This is where I struggle. Gold has a use case. You can touch it, you can feel it, and people are willing to use it as a form of transaction.
Well,
with crypto, what do you think is the use case?
So precious metals have had 2,000, 5,000 years to find this price and to get to that point of stability. And because they're physical and bound by chemical and physical law, they can't be replaced. It can't be diluted, although on the paper markets it is, right?
Yeah.
But down to, you boil it down to its most fundamental basic thing.
Right.
There's no real dilution there. So I agree that there's some superiority with precious metals and that there is to Bitcoin. So again, on a spectrum of sound money, it probably doesn't go all the way to strong as sound money ever. But there are things about it that I believe are going to continue to fundamentally support it, such as its ability to, move money around the world without anyone telling you what to do. I think the network is a little more resilient than just being able to be attacked, like the nodes you're talking about. I think it's harder to do. You have some of the smartest minds in the world contributing to this network. I think there's a
and hacking it
advantage. Even with these dilutions with the Bitcoin Cash and some of these other hard forks, I think there's a lot of resilience that, is being attributed to Bitcoin and continuing to build out. So this idea that there's no use case for it, I see it more as, a blue chip stock, in the Dow Jones, let's say, expecting it to go to zero. But I'm also optimistic. I mean, we watched Amazon go from very, very low to, over $1,000 and get crazy overvalued. And sometimes, bull markets will happen when fundamentals in many ways defy it. So to that degree, I'm open to Bitcoin, continuing over time and building up. And because of its dominance, its first mover advantage, continuing to, shock the world. So I understand, and I points well taken on some of the areas it has its flaws in, but I'm betting that it's still going to be around, which I know you said, and it's going to get stronger over time.
Yeah, it's a question of buying in. The thing that I coming out of Silicon Valley, you hear a lot of chatter about blockchain versus Bitcoin. I want to differentiate there. So blockchain enables a really interesting hot ledgering thing. So from a pure business operations standpoint, if you're Amazon and you're conducting business, you have to pay MasterCard or Visa their kickback because people like to use the credit cards. That's huge. You're doing $100 billion or whatever the magic number is these days for Amazon, and you're kicking back a couple $1 billion to MasterCard or Visa. If you could get off that, if you could encourage, and they've tried that, use our Amazon card or whatever. But if you could suddenly say, you know what, we don't need to use credit cards anymore, or credit cards, you can no longer charge 2%. It's just not going to happen anymore. That's meaningful for a lot of retailers and businesses. Where it gets even equally interesting is in the stock market. If you're JP Morgan or Citibank, you literally are required by various regulations to watch every paper transaction. Every transaction has this high level of oversight. And that means that you have on your books tens of thousands of employees whose job is to basically manage paper flow. With blockchain, you now have a way around that. And I think that's where you're going to start to see more of the interest, because the use case is a much more fundamental thing that a company CEO can see and touch. Wait, it's kind of like back in the 90s when first we moved over to having these IT departments that had servers and so forth, and then you migrated to the cloud. All of a sudden, the CEOs and the CTOs said, wait, you mean I don't have to have a team of people on hand? I don't have to worry about every update. Amazon takes care of that for me. It's basically become a utility. I can save money. And I think blockchain is going to enable that. I just don't know about the role of crypto, which sits over, which is, wrapped around blockchain. But we'll see. I mean, for me, I've been watching it go down. I don't invest in crypto yet, just because I still see it heading down. And that's just my investment thesis. And I have my reasons, like you said. I don't think you should embrace every single one of them, because we never know for certain. However, for me, getting into crypto at this point doesn't make sense. I'm still waiting for that bottom discovery, and I'm watching the cost of mining. Eventually, you get to a point where gold costs $1,200 because it's not on the beach and you can pick it up. You have to invest a lot of capital into mining for gold. It's finite and all these other things. Same with oil. There comes a point where if oil goes down too far, people stop drilling. We see that all the time.
Well, when you find that bottom or can identify it, I'd love to know. I don't know when that's going to happen, and I think it's a very difficult task to try to ring a bell when we do hit that bottom. I think we'll only know in hindsight, but similar to that $6,000 trading range we've been in from August through November, I think a lot of the community was like, hey, we're solidifying, we're building a base here, and then all of a sudden, right when you think that we've bottomed, the floor falls out again from under any asset class. And that tends to happen. And of course, the crypto market is so new and it's so infant that, the swings we're seeing is absolutely crazy. It's very, very volatile. So
you have to wonder, at this point, we don't know, like the Goldmans of the world have been in the market now for about 11 months or so, when it went a little bit more formalized. What are they doing in the background? Let's talk about the Winklevoss twins. They've got billions of dollars wrapped up in crypto. What have they done off on the side to hedge that position, to manage out the risk? Typically what you would see is, let's take someone who's in charge of a big company like a Cisco. They have all this concentration of wealth in their Cisco holdings. They probably turn to Goldman and they say, look, I will take my Cisco stock and give it to you, but you've got to do something off on the side that hedges that risk of concentration. And Goldman then takes that stock and does whatever kind of derivatives and futures tradings that they like to do. I would imagine that's also going on. And so now that the big boys are in there, like the Goldmans, that can also create a lot of this volatility. It doesn't necessarily take it out. It creates volatility because you get into these weird positions. Just as Bitcoin collapsed over the past couple of months in an accelerated fashion after it seemed to have started to bottom, so did the stock market, right? It collapsed too. The big boys oftentimes drive it up just as they drive it down. It gets oversold really fast. Again, for technical reasons. Maybe somebody hedged a position, like let's say the Winklevoss guys were in a place where they hedged their position and all of a sudden it fell below that magic number and they're stuck and they have to sell no matter what. Margin calls, fire sales.
Well, I think that's an interesting point. I mean, we're talking about big money in the crypto space now, which would have been unheard of maybe 3, 4, 5 years ago, talking about these asset classes, which have now become an asset class, which were just lines of code a few years ago and monopoly money. I mean, and I think that's a testament to where we've come and a further solidification of where we could go. And I would agree with you that there was some uncanny correlation to the futures trading and the height of the Bitcoin price. But I think we're early enough where just more mainstream adoption, whether it is paper contracts, ETFs, and all these other derivatives of the Bitcoin, underlying Bitcoin, my view is that I think this is going to add fundamental use case to the underlying currency in the interim until we do reach some sort of saturated phase, which in my view is much higher than where we are now because of the low market cap we have of Bitcoin.
Let's talk.
It comes down to your anchor and what you think the anchor is, and if there's value in your opinion in this underlying use case.
Well, there's one reason. There's one other reason I would throw out there on the table to feel somewhat bullish. I mentioned one is just because anti-U.S. craze, but there's a more mundane. To me, magic happens in that mundane stuff, like margin calls. Why do they happen and what happens? It's a mundane thing, but wow, it can have an impact. Right now, the SEC really hasn't blessed Bitcoin ETFs. You can't do it. And go back to everyone's got money in 401ks. But it's a mundane thing. There are rules and regulations about where can money managers put their money, their clients' money. And if you don't have a formally blessed ETF, then in other words, the demand is artificially constricted at this point. When the SEC blesses an ETF, that demand opens up. Let me share one more mundane challenge for crypto right now. And this is, again, it's the big money we're talking about that's going to drive, not you and I buying on the margins. There's something called custodial responsibility. And let me dive into this. It's so mundane, but it is literally the choke point right now. If you are a money manager, if anybody, if you buy a stock, you don't actually have the certificate. Charles Schwab is sitting on it if you're a retail investor like me. Charles Schwab, I buy Cisco stock, they're going to, quote, have proof that I bought it at a certain price and that it was sold by somebody at a certain price. They've got that. They are the custodial account. They're managing and proving, and it's secure. If I want that information, it's there. They guarantee it. Now, in reality, they're probably Schwab is kicking it back to someone else higher up. But in general, you have to have this custodial responsibility. That is the be-all and the end-all. And every time we do a transaction, some of that fee goes to paying for that custodial relationship. The problem was this. 2 years ago, someone like yourself bought Bitcoin, maybe it was $1,000, $2,000, and then all of a sudden, overnight, the damn thing's $5,000, $10,000. And you're a money manager, and it's sitting on a thumb drive, right? That doesn't pass muster with the SEC. If you're a money manager, you have to tell me that that asset is, once it's above a certain level of value, a couple $100,000, you have to vouch for it. It is secure. And telling me that it's on a thumb drive in your desk drawer is not going to pass muster. So what you had last year was suddenly all these money managers rushing around saying, who's going to be my custodian for the stuff? I took a flyer of $100,000. It's now worth $1 million. What do? I have to now do a lot of box checking with the SEC. Who is going to vouch for this? Because it can't be sitting on my thumb drive. As well as last year, there was a rash of thefts and hacked systems. Again, not necessarily the main ones, but enough so that, again, it caused some fear, doubt. And again, you get back to the SEC has some very clear requirements. If you're managing money and you are buying assets of any kind, you have to vouch that they are secure. And nobody was able or willing to come in, raise their hand and say, I vouch for a bunch of numbers sitting somewhere on a server because, by God, we've never had servers hacked before. And if anything's stolen, I will step up to it. And that was what last year was all about when it hit a certain dollar threshold. They still haven't solved that custodial problem yet. But if and when they do solve it, you will see a sudden rash of buying. Again, there are certain choke points out there that are limiting the demand. And again, that will add a little bit of tailwind. Something to think about.
Points well taken. Andrew, you're someone who is obviously very smart, and I think that was evident in the call we had today. So I appreciate your time here with us. If you enjoyed this interview, I encourage you to hit the like button, share it, tell your friends, tell your family about what we're doing here at Crush the Street. Andrew, if people want to learn more about what you do at moneyballeconomics.com, please let them know where they can go and what they can find.
Come on over, subscribe. It's free, moneyballeconomics.com. Every week we go into these kind of waters, use hard data to identify where you should be thinking as an investor. We also have the moneyballtrader.com, which is equity-specific ideas that you should consider. That is for fee.
All right, sir. Thank you for coming on Crush.
Thanks a lot for having me. Appreciate it, Kent.